Well, joining us more now is Jimmy Jang from Macro. Jimmy, great to catch up with you again. A positive session on global markets overnight, particularly in Wall Street. Tech stocks boosted by that announcement from Donald Trump and that joint venture on that investment in AI.
Morning, Andrew. Definitely has. Obviously, S&P 500 has reached that record high again, largely due to the Netflix and Oracle is being the biggest leader in the sector. Now, the question really is evolving around is can this momentum continue, or should kind of investors be very cautious and stay away from it? And it's probably a really good question to ask right now, with Trump's new government kicking in as of a couple of days ago. So what our view is that while the tech sector has been a key driver of the market gains, as we saw with Netflix stellar quarterly report, and obviously Oracle being the large company benefiting from that U.S. government's AI initiative, there are definitely signs of caution. So one of the main things is that those inflated asset prices are suggesting that the market current levels may already been kind of pricing in a lot of optimism. And additionally, those sector-specific pressures, such as the rising bond yields, despite the more than 100 basis point of a rate cut, the bond yields are being very resilient, and that's really impacting a lot of rate-sensitive sectors like utilities and real estate. That's obviously creating a drag on the broader indices. So while there is that momentum in tech, investors should remain very well diversified, more than ever in this current market, and be very mindful of a key word called valuation. That's probably our main focus right now in terms of our equity research, is whether these valuations are really fairly valued compared to the market, especially in a rising interest rate environment. Because in the US, if we see these tariffs being developed, this tariff policies being developed in the US, that could potentially put inflation at a higher rate, and the Fed has no other choices, if that's the case, to potentially even hike the rate again, which obviously is very unlikely right now. But if that really kind of develop, that could be the case. So we should be very cautious in that regard.
Jimmy, do you feel as though perhaps markets are in a wait and watch mode at the moment, as they're essentially waiting on greater detail from Donald Trump in particular on tariffs?
Absolutely. We definitely are of the view that the market is basically holding on to what they already have right now, and kind of see how these trade policies are developed. And obviously, we see some other kind of potential market where they are allocating a lot more in a hot stock or hot sector like AI. And that's our biggest concern, is that the main driver of the S&P 500 is taken by those tech giants. And if, for example, as we go through the next 6 to 12 months, if we see these kind of AI-driven businesses really struggling to convert into revenue that actually the market has anticipated, then we might actually see a really, really big drop. And so, what we would like to do is, although as much as we like the tech sector, we want to remain very well diversified. It's probably, boring as it may sound, but it's probably most relevant topic right now, is because the S&P 500 driver is just purely because of the huge driver of the tech. So I think that in our view, the market is definitely waiting for more certainties as to how these trade policies, and especially these AI push that the new government is putting to the market, and then from there, we might obviously find more conviction. And if that kind of costs us to buy at a higher price, then we're happy with that.
Jimmy, locally, what are you watching at the moment? I guess particularly from a macro viewpoint on the economy, and as we head into that crucial Reserve Bank meeting next month.
Very good point. At the moment, there's largely two kind of topics that's really driving the Australian share market. Obviously, very relevantly, what's happening in the US, which is really good. But at the same time, what the actual rate cut expectations are for Australia, contrary to what the Fed is doing at the moment. So at the moment, we got the RBA meeting coming up next month, and the market has priced in around 78% chance of the RBA cutting the rate. Which is kind of signaling that the central bank is definitely responding to a bit of economic headwinds. So we saw those job data coming out in December, so that's also kind of pushing more weight towards the RBA cutting the rate as well. But the rate cut, it typically definitely benefit equities. But our also concern is that the market has already expecting the two cuts by August, and it already priced that into the ASX 200. That's our view. So, just because we see a rate cut happening in the next month or so, which is what we kind of expected, we won't really see how that's going to be a big driver for the equity rally in Australia. And that can obviously is something that we need to make sure that, again, in Australia, diversification is key because, those rate-sensitive sectors like, let's say, property and infrastructure in Australia could be a potentially a good stocks to buy. But, for example, the banks are very overvalued at the moment, and that's usually the case if the RBA's rate cut is not going to be as significant than the US. So right now, definitely a very volatile situation for the Australian share market due to that, the market pricing in that 2 rate cut happening by August. So let's kind of see how the market will react in February.
Jimmy, speaking of volatility, one stock in particular, Star Entertainment, extremely volatile, coming under a lot of significant pressure yet again. What's Macro's view on that?
Star Group, unfortunately, is in a very precarious financial position at the moment. Ever since around November, we kind of did a further dive into Star Group, and the lenders are now really preparing for the potential voluntary administration. Now, what that means for the shareholders is very important to know, because if you look at their latest report that they released, they only had about $79 million in the bank account. And now that's going to be driven down even further, probably as of today. And that's after they're burning through about $108 million in just 3 months. So that's a critical issue for Star, already burdened with around $434 million in debt owed to various lenders such as Macquarie, Deutsche Bank, Salt Patterson, and Westpac. So these lenders are currently exploring these restructuring options, really kind of more weighting towards a voluntary administration. So they brought in the FTI Consulting and also one of the most respected restructuring lawyer as well to assess the options. And if they actually move forward with the VA, that could mean a significant loss for a lot of equity holders. And broader market-wise, that might bring even more uncertainties for a lot of these property developers and also a lot of these same companies in the sector. So one of the also key news that we saw over the last couple of weeks is the Queen's Wharf project in Brisbane is also kind of struggling. So as the viewers might know, the Star's Hong Kong-based partner, Choy Tai Fook and Far East, are demanding a 12.5% price increase to complete the apartments. And that's a huge problem on top of what they're already going through, because the apartments, obviously some priced around $3 million, will be a key part of Star's strategy to improve liquidity. Now, if these sales don't proceed as planned, that's going to further jeopardize their cash flow on top of what they're going through. So it's a tough outlook for Star Group, and the lenders are demanding some huge certainty. So that's why they engage these different various experts to potentially restructure the business. And I had a lot of inquiry from our current investors to potentially maybe see Star Group as an investment right now, and we're very, very cautious because although the stock price has rock bottom at its best, but with this kind of potential voluntary administration lingering around in the background, it's probably a stock that we don't want to touch right now. So, but we'll continue to monitor to see if there's any potential opportunity.
Whereas, and just briefly, Jimmy, GrainCorp, one that you are liking at the moment, why is that?
GrainCorp is a very interesting play. Obviously, the company benefits from that strong fundamentals, including its position as a key player in the grain storage, processing, and marketing. So, excuse me, the recent harvests in Australia have been really good, and the global dynamics such as that reduced exports from Russia and the US are favorable to the Australian wheat market. And in our base case, we've set the target price around $9, representing about 21.6% upside from the current levels. And we also see that GrainCorp has a strong balance sheet, so they have that protection from the downside of a potential economic downturn. And obviously, they have a valued East Coast assets and a pretty good dividend of 6% yield as well. So it's a solid option for investors looking for non-core Australian equities in our portfolio at the moment.